So it's important on your way into a joint venture, whether you're an investor or manager, to have a clear understanding of what the exit strategy is. This goes to both your target audience, your target returns, and also how you will market your property. For all the best intentions, obviously your exit strategy will depend on the market environment at the time. So you can have a clear understanding of what your intended exit strategy is, but that must also remain flexible to allow for differing market volatility and the environment in which you would be seeking an exit. The first consideration often of the JV parties is lock-in. Now, more often than not, there will not be a lock-in, so the investor is free to lead an exit, whether that be through some form of drag or a sale of the property immediately upon the investment. But occasionally, a lock-in period where there can be no exit will be negotiated for a fixed number of years. Usually within that lock-in period, there will still be a right for the various parties to transfer intra-group. So there will be still some flexibility to move your stake, but whether that be manager or investor, around within your affiliates. Thereafter, there are a number of different exit mechanisms that the joint venture parties, led by the investor, will be able to consider. And it is one size does not fit all. It will depend on the circumstances. Drags and tags are always an option, or usually an option. That is where the lead investor will be able to drag the minority shareholder, the manager, with them into an exit. The question would be whether there are any hurdles to the drag, be it through multiples or other valuation hurdles that must be met for that drag to be exercisable. And then a corresponding tag right in favor of the minority shareholder. There may be put or call options, depending upon what the negotiated position is, which would allow the lead investor to call the minority shareholder if it wishes to acquire 100%, or also for the minority shareholder to put its minority stake onto the lead investor. There will also be, or usually be, a right of first refusal or right of first offer on any sale to a third party. So neither shareholder can sell to a third party without first offering that stake to the other joint venture partner. Valuation will be key for all of these things. There will almost always be a tried and trusted mechanism in the JV agreement where a third party independent expert valuer is appointed to determine the value. From January 19, the IPSX was launched, which is the first and only stock exchange dedicated to commercial real estate. So an IPO is now a viable alternative for an exit for the joint venture partners, albeit it is in its infancy. One of the advantages is that the issuers are classified as REITs, and that will give them beneficial tax treatment. Some exits may be forced on the manager with respect to both its minority equity and its promote fee. Now, these usually relate to default events. If they are in default under the joint venture documents, there will be, or are likely to be, a mandatory transfer event, and in that scenario, the manager will be forced to sell, and more often than not, discounts may be applicable to the FMV of the stake. The other thing to note is that in any circumstances on the termination of that manager's management agreement, it's likely that the investor will have a right to acquire the manager's equity to ensure that the equity and the management agreement are always linked and connected.
Historically, exit planning was always a big focal point because if you structured your arrangements correctly and you established a corporate structure to hold, in this case, UK real estate, you could exit from the investment without paying any real UK tax at all. This rule has been stopped. It's no longer possible to do that, and anyone looking to invest in UK real estate would have to expect to pay some capital gains tax on an exit. That notwithstanding, there are other taxes that can be managed by careful planning. For example, how are you going to sell the asset? Are you going to sell the shares in the company that owns it? Are you going to sell the asset itself? These are all considerations which have their own tax characteristics. And therefore, exit planning is important to know how you're going to leave the structure whilst minimizing tax and mitigating your obligations at the end of the day. This means that when you establish the structure in the first place, you should have a clear path as to how you're going to exit the structure so that you can reach that exit strategy with a maximum of tax efficiency along the way.